And good afternoon. My name is Randy Price. He is Matt Price, and welcome to our special webinar here based on what's happening in the world for the month of April. We've titled this Market Volatility, and that may be a little bit tongue-in-cheek, but that's exactly what we've had. A lot going on in the news, a lot going on in the investment markets, and we're going to try to go through and take perhaps a few more minutes than we usually do, but give you a good feel for where we are, where we're going, and some actionable thoughts to consider as we look at market portfolio. We are the Price Group, family owned and operated, 60 plus years of experience. Over 80% of our clients are retired. We do follow a fiduciary standard, and we are here to help and give you some perspective, again, on events recently transpired from the tariffs and causing the market volatility.
We still have a few names trickling in. It looks like quite a few clients on the call, but also a few new faces. For the new faces, welcome. Alongside the clients, welcome as well. Randy has been humbled to get a number of awards from Forbes, Financial Times, Barron's over the years. Randy, Maddie, myself, we're all certified financial planners. We think education is vitally important in this profession. Randy and I also both went to the Wharton School of Business to get our CIMA, Certified Investment Management Analyst designation. If you're not on our current email list, what we call the Retirement Insider, shoot me a note and happy to add you. Obviously, all clients are already on that list, but anyone new, we're happy to add you to the list as well to receive emails. Our firm, Steward Partners, based off the biblical definition of stewardship, our custodian, where client assets are held, Raymond James. They've been a good vendor and partner over the years. But with that as by way of a quick introduction, let's go ahead and jump in. We got approximately 20 slides or so. Any questions along the way, shoot me an email. We're happy to hop on the phone after this call to answer anything in more detail that we do not cover. So starting off here, the review of the announced tariffs. This is just by country of what the White House has put into place. The reason we're bringing this up is the actual amount is maybe not as important, but the negotiations that are currently happening are not only on the stated tariff amounts, which you can see on the slide, but also on what the White House is calling the hidden tariffs, or think, for example, in the UK, the VAT tax, things that are not in America's best interest. So it's a little bit of a two-pronged approach from the way the White House is approaching this. We honestly don't think the White House wants tariffs in place long-term. So that will be a key point. You'll hear us talk about that a few times here over the next 30, 45 minutes or so. The media is trying to create a story that no countries are wanting to negotiate. That's not what we are seeing. We think actually a lot of these countries are coming to the table to negotiate to see what they can do to reduce or remove these tariffs altogether. Obviously, China is not on that list, but a lot of the other maybe smaller to medium-sized companies are. We had a client ask us just yesterday, said, it feels like this is from the scene in the movie Pearl Harbor. If you all have seen that movie, where there are two planes going at each other and they're playing chicken, and we're going to see who turns first. And I thought that was a decent analogy. We don't think that this is a long-term strategy in Washington, D.C. We think this is more of a short-term negotiation tactic. We're not saying we necessarily agree with the negotiation tactic, but it is that nonetheless. So with that,
let's go back just 1 second there, if you would, please. Where tariffs actually came in after the Second World War, the United States was king of the hill, and we instituted a number of favorable trade agreements with countries that were rebuilding to give them a leg up, and that stuck, and it's has gone that same direction for years. And again, in an interest to rebalance the economy and make it better for the United States, the president has determined that these negotiations will commence. The news just recently today is China, being the Lone Ranger, has said no, and those tariffs will go higher than even the 54%. So I thought this was a great title. Drama indeed has occurred, and have we reached a crescendo on that? It's interesting to look back. On Monday before the tariffs were announced in the White House lawn meeting, the market was just sort of shrugging everything off. And what happened between it and the sell-off that began on Tuesday, week ago today, was the amount of the tariffs. The market and investors had expected something in the 10 or 15% or whatever, and voila, they were a lot more. And so the drama ratcheted up quite a bit. There are all sorts of estimates out there on where the tariffs will end up. This slide we detail the worst at a 31%. And again, that can vary from country to country, but as Matt pointed out, there's things other than the tariffs, including currency manipulation, and then just some arcane rules where the American products never have had a chance in some other countries. So you can see there the current effective tariff rate from 1905 and how it sloped down again, beginning ever since the 40s, from the end of the Second World War, and where we are today. Hopefully, again, as Matt has pointed out, this is something that gets settled fairly quickly. The market does not like uncertainty, and what we've seen is the VIX, or the measure of volatility, has spiked based on a lot of people worried about what's going on and not knowing how to look at corporate earnings. A stock price at the end of the day is the sum of the discounted future earnings of a company.
One thing to add on this slide before we go to the next slide, Randy will talk about this here in a moment. The current rates of the effective rates for tariffs, as you can see, really dating back to the 70s, have been less than 5%. So we're going to go call it 3% round numbers. And the best case, our estimate, just based on where everything is today, it's going to be 22 to 23%. So keep in mind that 20% increase, as Randy talks about here, some of the math behind what that means to the overall economy moving forward.
So economic growth and inflation, how do the tariffs affect the economy? Well, they affect interest rates. Interest rates on the 10-year Treasury actually dropped below 4%. Inflationary expectations, the price of oil went down. We saw a really interesting situation yesterday, which was really a pivot of $1 trillion or more, where the market was up quite a bit based on what turned out to be a false report that Trump was going to pause the tariffs, and then the market sold back off. So it's a big deal on the potentiality on economic growth and also inflation. The rule of thumb there on economic growth, 1% increase in the tariff rate would reduce GDP, gross domestic product, the sum of all goods and services, by 0.1 percentage points. And 5% increase in the tariffs could reduce our GDP from 2.4 to 1.8. Now, as Matt said, there's been a lot of talk about a recession, and the problem with a recession, we've said this many times before, is the word recession sounds a lot like depression, and they're totally different. A recession is 2 straight quarters where the economy shrinks. Well, the economy could shrink 0.1% or it could shrink 10%, but there are some mitigating factors on the tariffs. The whole goal here is to create more domestic jobs, to bring back factories from a foreign defense, as well as from just a job generator, increase company revenues. All that happens. Again, the goal, and we think one of the key things is that the fiscal federal deficit has to be addressed at some point in time. Deregulation could be huge as well. Inflation, the hidden tax, and this is debated, but we could see an increase in inflation of 0.1% on there. Obviously, the higher the inflation, the higher the cost of living. But what we've seen is lower interest rates. What we've seen is lower oil prices, and these would mitigate some of the effects of the tariffs. And again, stay tuned and see. But it's certainly an interesting time to be alive in the United States of America.
The title, There's Always a Crisis. My grandmother used to say it's always something. And I think this slide is a depiction of that. We're looking back till 1970, so the last 50 plus years. And what you can see here are every crisis that have really affected the market in a material way over the last 5 or 6 decades. We like to say the market historically has climbed the proverbial wall of worry. And you can see that here. And we don't think tariffs are going to be any different. So right now, the weight of this tariff debacle feels heavy, and we don't know how necessarily it is going to end. What we'll say is this: we don't think this is the end of America as we know it. We think it is a prudent thing to remember. We don't like betting on the end of the world, because the end of the world only happens once. And so what we want to do from an investment standpoint is we don't want to plan for what's possible. We want to plan for what's probable. And the most probable outcome, in our humble opinion, is that there is some type of resolution on both sides between America and all these different countries. And then we continue back climbing this proverbial wall of worry. So if not tariffs today, it will be something tomorrow. But that's what we'll talk about here on the next slide: long-term investing versus trading. And it's been a really bad experience if you're a day trader or you're just trading in and out of stocks over the last few weeks or even the last few months, just with the fact that things are not moving higher and you might not have a long-term time horizon. For all of our clients, we look at the world with a long-term perspective. So with that being said, we're not making investment decisions based on what we think will happen in the days or weeks ahead. We think we're making investment decisions on what we think are happening in the months and the years to come. So what you can see here, the dark blue, are some of the bull markets. With how the bull market is defined based on this slide, the bull market is lasting on average from 5 to 10 years. As you can see, there's a few periods that are actually longer than that. And then the yellowish orange there are the bear markets, or the negative periods. And two pieces I want to point out. Number one, just the duration of the two. You can see that bull markets, good periods, tend to be much longer when compared to the bear markets, the negative periods. And then number two, just the actual height of the bull markets as it's depicted in the slide here. The bull markets tend to run a lot longer in a positive form when compared to how far and deep the bear markets go on the downside. So right now, with how this is set up, we're coming off of we think we're 2 to 3 years into this bull market. 2022, as many of you remember, the market was down, round numbers, approximately 19% for the year. So with that being said, we think there is room to run just from a growth perspective. We don't think this bull market is in the 9th inning. We think it's probably in the 3rd, 4th, 5th inning, to use a baseball analogy. But with that being said, part of being a long-term investor is unfortunately some of the volatility that we do experience from time to time.
So stocks have won. The good news, since looking back here to 2007, annualized return of stocks right at 10%. Gold, the 10-year Treasury. That fourth item, the CPI, Consumer Price Index, has come in there. And so let's talk about inflation just a little bit. Hard to get where you need to go if you're looking to retire, or if you're retired and needing increasing income to offset inflation without owning stocks. And so that's a whole decision on your risk budget and what the proper allocation toward equities is. Those of you that are clients know that the Price Group are big fans of dividend-paying stocks. or the perfect multi-generational planning tool. If we're doing our job right, not only do we make money, but we get an increased dividend stream, and retirement is all about income. But what do you have to worry about? Well, and a lot of people are mentioning this in the news with regards to inflation. And remember our rule of 72 that we talk about. If you have 2% inflation, divide 2 into 72, you double your cost of living every 36 years, okay? If you have 6% inflation, 6 into 72 is 12, and so you can double your cost of living every 12 years. Somebody retires at 60, you can see they have several 12-year periods in an average lifetime. And so if you're younger, you need stocks because, again, there's a longer period of time for inflation to compound as well. Stocks typically act as a great way to keep up for your purchasing power in retirement. And volatility, it's really just the cost, the price you pay, if you will, to own some stocks. Again, we point out to our clients, and we are firm believers that not all are stocks created equally. We've been pleasantly surprised that we've had some client conversations in the past week on, and again, from historical data as well, how our different flavors of dividend ice cream have held up. And again, more income is good. And as I was talking to a client earlier today, if you had 100% of your money in stocks, which normally no one would, and the market was down 20%, unless those companies cut their dividends, your income hasn't changed. And if they increase their dividend payment, which many do, the good ones do, then you're better off even when you started, even though the market is down. And we say tongue in cheek, if you're retired and the values are down, that's the next generation's issue. So anyway, stocks have won, and again, unless something really happens, we think we'll continue to post some gains. This is following the great financial panic of 2008. We don't think things are anywhere close to what was happening back then at this point in time. So we every once in a while have someone will say, you know, let's just get out and go to the sidelines, or let's wait on putting some money to work, wait till things settle down. Well, the market is forward looking, typically out 9 months. And so what you're doing is you're trying to match wits with people that do this for a living and have done this for a living. And so the market is the best way to participate. If you miss the best days in the market, if you're in all days, missing the best 5, missing the best 10, missing the best 30, missing the best 50, if you miss the 10 best days each year, the 10% average return we saw on the previous chart drops to about 4% per year. So 2 things have got to happen when you decide to get out of the market. And we've seen people do the first, sometimes more so than the second, and that is getting out, but getting back in is more problematic, and typically is where people really stub their toe and cost themselves some money. Warren Buffett says that timing the markets over the long period of time is impossible. We think Warren has done a pretty good job of not doing that. And again, we would encourage dollar cost averaging as opposed to just a complete market timing type move, because typically it's very, very difficult to make the move to get out and then make the move to get back in.
So with a similar line of thought here, we're looking at the probability of positive returns. We had a client say last week, well, Matt, I kind of feel like I'm at one of those casinos on the strip in Las Vegas. Am I just at the roulette table thinking our stock's going to go up here? And so we pulled it up on Google. The odds of winning a roulette bet are about 48%. And you can sit there and you can play all day and all night, and your probability of success is not going to increase or decrease. Each time you play roulette, it's going to have about that same 48% if you're trying to hit red or black to win. What you can see here depicted on the slide is your probability of success, or what we deem positive returns, owning stocks over a long period of time. And I want to draw your attention to the 10-year bar there on the far right. If we own stocks over a 10-year period, which typically is what we consider a market cycle. So market cycle would be having some good years, having some bad years, having some maybe sideways years. But over a market cycle, there's a 97+% chance that you make money in the stock market. And so that's how we think about the world. We're thinking about investing in a long-term time frame. Like Randy said, we're not looking to buy stock A on a Monday and possibly sell it for a quick gain on a Tuesday. We're looking for companies that not only pay dividends, but historically have had the propensity to increase their dividends year over year for the duration of your retirement. Now, we will make changes if and when we think that the market dictates. We've made a few changes to the portfolio here over the past week or two as it pertains to some of the dividend-paying stocks, and also looking at some changes potentially in the fixed income, but we're not going to just make changes to make changes. Here on the next slide, a little bit of a busy slide. Let me explain what's going on, titled Staying the Course. So the red, call it an orange, or probably more close to a shade of orange, that is the intra-year decline each calendar year dating back to 1980. So for example, let's look at 2020. They're kind of on the right side of the page. You can see a negative 34% intra-year decline, which happened March of 2020, when really the whole world was temporarily shut down from a business perspective. However, that chart, that bar there on top of it, the darker blue of the plus 16%, the market ended 2020 plus 16%. And so what we want to draw your attention to in this slide here is over the last 45 years, history is full of examples of which there are intra-year declines, yet the market ends on a positive note. And so we don't know what we don't know. We don't know if the market ends higher for 2025, but when we look back historically, statistically, what we do know is that this is not the end of the story for 2025, and we think there is a good possibility of the markets having a rebound once there is some type of tariff or trade negotiation that is finalized between each country. So with that being said, we feel good from a standpoint that we still have 7 or 8 months left in the calendar year to try to make up for a little lost ground here over the past month or two.
We talk about this often, but for one reason or another, the market almost always has an intra-year decline of at least 10%. So sometimes makes sense, sometimes doesn't make sense. I read a funny article one time. It said the market goes out of its way to try to make the maximum number of smart people feel really stupid. And I thought about that, and I thought, yeah, there's some truth to that. So, anyway, as we look here, there are positive and negative returns, and this lays out 73 positive years. The average positive return, 21.5%, 26 negative years, negative 13.4% return. And from a standpoint of that, you can see the different years and where they are. We went back and looked, and we said if you had a 25% rate of return in year 1, 26% in year 2, and then negative 13% in year 3, this comes out to about a 12% average, and that's exactly what has happened if you've been fully invested over the past 3 years. Obviously, or not maybe obviously, but this particular pullback this year, because it came out of nowhere, because it was unexpected, and because we've gone so long without a pullback, it felt a little bit more harsh, a little bit more painful, a little bit more surprising, perhaps, than some of the other ones. But the 99-year average return in the stock market, 10.4%. Now, there's some people who say, hey, invest in stocks, you'll make 10.4% a year. We think perhaps that's going to be muted going forward. And we don't think your distribution rate can be nearly that. That's a whole nother story and a whole nother analysis for each of us to look at individually as a family. But again, the stock market has typically gone up over the years as businesses have made money. And again, don't bet against the don't bet against the stock market over the long run. Recession, again, we talked about 2 straight quarters, recession drawdowns and subsequent year returns. This to me is one of the most interesting slides in that you see the drawdown and then the returns 1 year, 3 years, and 5 years later, going back to the 50s and then all the way up to 2020. After the average 3-year return after each of these drawdowns going to about 1953 was a staggering 65%. The average 5-year return was over 100%. Matt's made the in some of our retirement insider, he said history does not repeat, but it often rhymes. And so, you know, one of the most laughed at terms that some of these people write about is, well, this time is different. And we don't think this time is different. Again, COVID, you could have said was perhaps different, but you know, COVID was going to perhaps wipe out the whole world with a virus, and that turned out not to be true. And you know, the tariffs are going to cause a worldwide recession. Some people said, and that's possible. But again, as Matt has pointed out, we assign probabilities, geopolitical tensions. I mean, there's a number of things on that wall of worry that the market climb. But history is indeed our friend here after a big drawdown going forward 1, 3, and 5 years.
It's a little bit just contextually about what has happened from a macro perspective and a historical perspective with the markets. Let's spend a little time here looking specifically at the economy, and then we have a slide or two as it pertains to bonds and fixed income. Is the U.S. economy headed for a recession? We do think that the probability of having a recession has increased from this time last month. In a similar vein, we've said that we think there were going to be 1 to 2 interest rate cuts by the Federal Reserve this year. We've increased that to 3 just based on the recent activity. Not all recessions are created equal. And if there is a recession, we think that it would be a more mild recession. Just from a standpoint, the economy was on solid footing prior to all of this. And then you can see here on the right some downward pressures actually to some of the key pieces of information that are studied as it pertains to what the consumer price index could be moving forward. Slower economic data, wage growth is easing, falling energy prices is helpful, easing monetary policy, and excess savings are depleted. So we think that there could be a little bit of a reduction in inflation to possibly offset a increase of potential inflation from the tariffs. So it's going to be a little bit of two competing forces here, but we got a force that's competing to keep that inflation lower that some of the new tariffs could possibly create here in the short term.
So what do those potential Fed rate cuts do? A lot of us got used to that 5% plus money market, where money market had been 0 for so many years. That 5% money market is now 4% money market. And with a couple of rate cuts, obviously it goes into the 3% money market. And you need to hold cash. Cash is not an investment, but it's a good place to park money. And again, that comes into to planning for cash flow, planning for what you'll need during retirement for your cost, your standard cost of living.
And then we just briefly mentioned it there on the last slide. We've increased our probabilities to a 50% chance of having a recession. One of the things that we like to remind clients, and Randy's already done this once today, is stocks are a forward-looking entity. And so we had a conversation earlier this week, clients saying, oh boy, you think a recession's coming, I guess we should probably sell our stocks and wait until it passes. And that is good linear thinking, but the market is not always going to act in a linear fashion. And so when we look back at history, the market will typically bottom prior to the recession actually being at its worst part. So we've seen cases, if you look back at history, where the market bottoms prior to the recession actually starting, which is a hard thing to really wrap your mind around. So we don't think a recession in itself is a reason to abandon ship, to alter your overall investment strategy, just given the fact that recessions are not fun, but they are a normal course of the economy growing when we look back at the last couple of decades. And we do believe that a recession would be short term, and another key word, shallow. We wouldn't see this as a 2020 type of recession where the whole economy does shut down, but something that is more muted and shallow in nature is much easier to come back from on the other side.
So could the U.S. market have an immediate positive impact, or could the situation there? What has happened in the past is when there has been volatility, it's typically been a good time to buy as we look back at history. I love that word, other signs of capitulation. Record put volumes, the VIX, the measure of volatility, and the number of bearish investors. But you can look through 2020, 2001, the years on the left-hand side, the performance through April the 4th, these are years where we've had declines of greater than 10%. And isn't it amazing? Other than 2020, we got to go back to 2001 and then look at the rest of the year return. Matt talked about that being the COVID year on there, but the markets in turmoil sometimes can be a contrarian indicator. And after the recent decline, the takeaway here is stocks have a potentially robust upside. The tariffs get settled, and I think the best example of that, and we put this together before then, but yesterday, when there was going to be a pause in the tariffs, as mistakenly reported, the market went from down to up in a big way really quickly. And if you turned around to throw something in the trash can, you missed it. And so again, what are the fundamentals of the economy? What is my retirement process? We talk a lot about don't make knee-jerk reactions, but have a process in place. What you'll find is a lot of folks who have not done so well investing will make rash decisions, jump in, jump out, and we say, let's have a process. Let's evaluate things. Let's look at it. And from a standpoint of that, we think there could be a real contrarian indicator here with what's going on with the tariffs, et cetera. So what do you buy during market volatility? One client said, Randy, groceries. But no, we think groceries are great, but where do you put your money to work for some income? You know, retirement is all about income. 40% or more of the total return over time comes from dividend. And when a stock does move lower and they pay the same dividend income, then the percentage that you get each year is higher. So in the dividends contribution to total return varies by decade. You can see the 40s, the 50s, 60s, the 70s, 80s, 90s, and so on and so forth with regards to that. Historically, what we've seen is our dividend portfolios have exhibited less risk than the overall market. So if you go down less when there is volatility, when there is some real concern about what's happening in the world, then you can recover quicker. And again, we think dividend stocks are a perfect multi-generational plan. They're a perfect plan for retirees because the stocks will increase their dividend and offset inflation.
Thought this was possibly a catchy title to the slide, Mr. Not So Irrelevant, the bond market. Bonds have gotten a little bit of a bad reputation over the past few years, just with interest rates going up since 2022, really. But thus far this year, the commercial for bonds has held true. And what I mean by that is we've started off the year with a higher income amount when compared to the last number of years, highest in a decade. You can see looking at that chart on the left, and bonds really have provided a good ballast to the ship, or a great diversification to stocks as a whole thus far in 2025. What I wanted to do is just use a kind of simple cowboy math example to maybe illustrate that point. The market from peak to trough, so the market peaked just a week or two before Christmas. And from there, from that point, the market's down approximately 20%. Based on what Randy said, dividend stocks typically having less risk than the overall market. Let's say for this year, dividend stocks are down 12%, okay? Let's say you have about half stocks and half bonds. We don't have cookie cutter portfolios for clients, but just for the sake of simple math here, so we can do it in our head, bonds are up approximately 2% for the year. So you got half your portfolio down about 12. You got half your portfolio up about 2. What that would mean is your portfolio is down approximately 5% for this calendar year. Now compare that to the down 20% number from peak to trough that we mentioned earlier, and it I think proves the validity of having some bonds, some non-stock investments built into a retirement portfolio. So we're very happy with how the bonds have performed thus far. It's a great reminder for clients, but quite frankly, it's a great reminder for all of us at the Price Group why asset allocation really matters. And our goal, remember, with your Live Well plan is we want to take the least amount of risk possible for you to be successful in retirement. And a big piece of that, not the only piece, but a big piece is how many stocks versus bonds do we own in the portfolio. And it's times like this that we're thinking about when making those allocation recommendations.
So the bond market is relevant, is what you're saying, Matt.
Yeah, it is. It's a lot more relevant than we
That's
thought
good
maybe a year
news.
ago. So with this, I'll let Randy chime in here with maybe adding a few more thoughts as well. But what are our recommendations? Where do we go from here? We think you lean into your investment process. It's not something that we're just thinking about, should we buy this stock, sell this stock? We have a bona fide written down process. Our investment committee is meeting now on a daily basis to discuss if and what we need to do to client portfolios. This is where we really will counsel and encourage clients to lean in and understand exactly how much income their portfolio is generating. And a lot of clients, not all of them, but a lot of clients are pleasantly surprised when we tell them, hey, the money you're taking out from your investment portfolio is generated by the income we're producing. And happy to report, so far this year, we have not had any dividend cuts, meaning the income has not moved lower on what we're producing, even though values look down on monthly statements or when you log in online to look at your portfolio. We've also looked at a number of Live Well plans for clients, as you might expect, over the past few days. And I like to say, we plan for downturns like this in your Live Well plan. So we show each family going through retirement 1,000 times, and we show market drawdowns during your retirement. What we don't know is really the timing of that drawdown. The timing will sometimes catch us by surprise. But with that being said, drawdowns like this really don't take our Live Well plan by surprise, which is a good thing. You don't necessarily see that probability of success move a whole lot with the downturn that we've seen thus far. That's something we'll continue to keep our eye on, especially for clients that are about to retire or have just retired. But that's another key piece we think is very fruitful in the time of market volatility like we're experiencing. And Randy, how about you talk about the last few here?
Yeah, back to just one thing, that sequence of returns is critical, whether you start out with a real positive period or a real negative period. And the more you can have flexibility in what you're going to spend during retirement, the more you can understand your risk budget, and not listen to some of the stuff. What you got to remember, and it's very difficult to do so, is that the people doing the news are not your friend. They are looking for clicks. They are looking for eyeballs. They are looking for people to watch. And, you know, the old adage, if you were a news editor on the TV station, was the saying, if it bleeds, it leads. And so the worse the news, the more the people will tune in or will click and read an article. And so, again, let's look at history. Let's look at your situation. Let's personalize where you are. We talk about, if you do block out the noise, if you do trust the time-tested strategies of asset allocation and diversification, and I would add in there holistic wealth planning, you get in your life the clarity. And if you have clarity, that clarity will lead to confidence. And if that confidence is there, it will lead to comfort. But what happens is the Live Well plan, as Matt pointed out, retires you through a Monte Carlo simulation 1,000 times. And so you can see a probability of success, and you get to be able to lean in. You get to be able to lean back, if you will, as well, and relax, and not so much worry about the ride. So a lot of people have not really considered asset allocation the way they should. I've always been a bond guy, or always been a stock guy. Well, we think both have some merits, and a diversified portfolio can be your friend during these times. But planning would be one of the secret sauces of the Price Group. And again, great time and a great reminder for everybody to review where they are. So speaking of time, we are very appreciative of your time. Ran a little bit longer than that based on the extra amount of sort of goofiness going on in the world. Feel free to reach out to us with questions, with comments. As Matt indicated, if you're not receiving Retirement Insider, that is a great weekly perspective on what's going on in the markets. If you have a question offline, we can be reached at the email address or the phone numbers there. That's Preston, Tiffany, Maddie, myself, Matt, and Melissa. And we think everyone needs a wealth coach. Thanks again for your time. Have a great rest of the afternoon. Hope to see you soon. Thank you.